we've all heard the mantra in trading, haven't we? The trend is your friend. It's practically etched into every beginner's guide to Forex. But honestly, what does that really mean in practice?
Yeah, it sounds good.
Right. How do you actually define a trend with real precision, measure its strength, and most crucially, how do you write it without getting burned? It sounds deceptively simple, but I think the truth is most common approaches leave you guessing.
And that guesswork is precisely what we're tackling today. It's a huge problem. Our deep dive takes us into Sunil Kuchal's incredibly insightful book, A Practical System for Trading Forex. We're calling him SK today. We're going to unpack key concepts mainly from Chapter 3, focusing entirely on SK's unique methodology.
Okay.
It's really about moving past those vague definitions to pinpoint trend direction and then, with remarkable precision, identify your optimal entry and exit points.
Right.
The goal here is to help you become a far more informed and ultimately maybe more disciplined trader.
So, our mission for this deep dive then is to cut through all that noise, past the subjective interpretations, and give you a clear, actionable understanding of what a trend truly is in the Forex market. We're aiming for the kind of insights that genuinely make a difference when you're looking at those charts. Let's get into it.
Let's do it.
So, SK starts Chapter 3 with this really powerful analogy. It immediately resonated with me. He asks you to imagine driving on a completely dark, unlit dirt road. You're crawling along, feeling nervous, maybe, 27 kilometers an hour?
Super slow.
Yeah, and suddenly, a guide car speeds past you at what he calls a smart clip. Say, double that, 54 kilometers an hour. What's your natural reaction? You breathe a sigh of relief, right?
Heavily. You've got someone to follow.
Exactly. You accelerate to follow, keeping a safe distance, not so far behind that you lose sight of them. That, SK explains, is the essence of trend following. You pick a reliable guide, and you stay safely in its wake.
And this analogy, it really highlights the core problem many traders face, doesn't it? Most people, when they talk about trends, they loosely define them using lagging indicators like, say, a 200-day moving average.
Little classic one, yeah.
Right. But the Sunil calls this a crazy idea. His point is that a Forex pair doesn't respect your moving average, it just doesn't care about your calculation.
It doesn't know it's there.
Exactly. Which raises that important question. If not a moving average, what kind of measurement should we use? Simple. Exponential. Linear weighted.
Yeah.
Smoothed. Which one?
The truth is, relying on these traditional averages often leaves you constantly second-guessing. Is the trend really up or is it down now?
It's like Sunil's other vivid analogy.
Yeah.
The flying dragon. He says you wouldn't be foolish enough to sit directly in front of a fire-breathing dragon's face.
Definitely not.
You sit on its neck or shoulder, right?
Yeah.
At a safe, respectful distance, because standing in its way, trading against the trend means you will get toasted, guaranteed.
Guaranteed. It really underscores the danger, the almost guaranteed loss, if you don't have a precise, unambiguous definition of what the trend actually is before you even think about placing a trade.
That's the fundamental issue with moving averages, when precision is your absolute goal. They became popular partly because, while they were computationally feasible with early computers back in the mid-1930s,
Right.
yet, successful traders like W.D. Gann operated effectively long before them. They didn't need them. The problem is that moving averages, they just blur the exact entry and exit points.
Right.
They leave you in this ambiguous zone, unsure if a minor pullback is a real trend reversal or just, noise.
That hesitation can kill you.
Absolutely. It leads to uncertain trades, often with these fleeting profits that quickly turn into losses. For consistent trading, getting a precise answer for when to enter and exit is absolutely vital, and moving averages simply don't provide that level of clarity.
Okay, so if moving averages are fundamentally flawed for this kind of precision, what does offer it? This is where it gets really interesting, I think, because SK champions a completely different way of seeing the market. It's a geometric approach.
It is, and what's truly fascinating here is how Sunil defines that geometric approach. He's not just looking at numbers in isolation, he's looking at how price points relate visually on the chart. It creates these definitive angles and positions, and this distinct visual clarity leads him to a really powerful tool from the Ichimoku system called the Chikou span.
Chikou span. Okay.
It's deceptively simple, really. It's just the current price plotted a specific number of periods behind on the chart.
So it's not an average.
No, not at all. Its genius lies in allowing you to directly compare the current price to a historical price at that exact same spot back in time. It gives you an immediate, unambiguous visual of the trend slope and direction. It's a direct comparison, pure geometry.
And Sunil uses yet another brilliant analogy here to help visualize this tool. Water skiing.
Ah, yes, the water skiing.
Imagine you're water skiing, right?
Right.
And you're being pulled by a boat, say, 27 meters ahead of you. That boat, which is your Chikou span in this analogy, is doing all the hard work navigating, avoiding obstacles like shallow water or rocks.
Mm-hmm.
You simply follow along at that set distance, reacting to the boat's turns. The Chikou span works in the same way, pulling you along at a set distance from the market's true direction, allowing you to react clearly to its turns.
Building right on that, Sunil places significant emphasis on a specific time frame, the 27-period trend on a 30-minute chart. He defines this as a 13-hour trend. Now, 27 periods on a 30-minute chart is 13.5 hours. He just rounds it to 13.
Okay, 13 hours. Why that specific period?
Well, this isn't just some random number SK pulled out of thin air. This 13-hour trend is what he identifies as the absolute smallest trend you should consider trading if you want to minimize your risk.
Smallest, but still reliable?
Exactly. It's sort of the sweet spot where the market develops enough momentum to give you a reliable direction, but without exposing you to the extreme volatility of much shorter time frames. It's where trend stability truly meets timely entry. It's a foundational insight for disciplined risk management that really sets the system apart.
That's precisely why it's so powerful then.
Yeah.
For instance, if that 27-period Chikou span on your 30-minute chart is visually sitting above the price from 27 periods ago, which represents that 13-hour look back you mentioned, then the trend is definitively up. There's no guessing involved, no subjective interpretation needed. It's a clear binary signal, yes or no,
Black and white.
which is invaluable when you're making split-second trading decisions.
Absolutely. And to further enhance this precision, and crucially to control risk, SK integrates Donchian channels into a system.
Donchian channels, okay, what are those exactly?
They're essentially lines, pretty straightforward, that highlight the highest high and the lowest low over a set period. So they create these upper and lower bands, and there's usually a midpoint line too. SK considers the 13-hour Donchian channel as one of the most important elements, specifically because it provides another precise tool for risk management alongside the Chikou.
Okay, and to truly grasp how these channels help control risk, Sunil gives us another brilliant visual, the jackknife diver analogy.
Ah, the diver, yes. Good.
Think of a diver, right, curling up midair just before they plunge into the water. At that moment, that curled up position, the distance from their head to their toes, their overall range, is at its absolute smallest.
Right, they're coiled up.
Exactly. This curled up position isn't just about finding a narrow price range. It's about identifying the moment of maximum coiled energy within that 13-hour Donchian channel. It's just before a significant directional move, either a reversal or a continuation. SK says it's the least risky point to take a trade. That narrow 13-hour Donchian range is crucial for managing risk. It gives the trend just enough room to breathe while minimizing potential losses if you're wrong.
It creates a crucial two-step process, really, that dramatically increases your probability of success. The trend, as identified by the Chikou span, that's the first event you observe, tells you the underlying direction. Is it up or down?
Step one.
Step one. But it's then confirmed later by a Donchian channel breakout. That's step two.
Ah, so it's a confirmation signal.
Precisely. This two-stage confirmation helps you distinguish between a true, significant market shift and just, random market noise. It ensures you're entering with much higher conviction.
Okay, with that foundation laid, understanding the trend geometrically, using Chikou and Donchian, let's turn our attention to the actual act of trading. Once you truly understand the trend and how to identify it, how do you actually trade it effectively? SK emphasizes that trends in Forex never, ever move in a straight line.
No, they absolutely don't. They undulate.
Right. They're comprised of smaller, these sort of wave-like movements.
That's absolutely right. And he precisely defines these smaller movements. He calls them dips, which are temporary swing lows within an established uptrend,
Okay.
and rallies, which are temporary swing highs within an established downtrend.
Makes sense.
And Sunil's advice here is incredibly clear, almost like a commandment. If that 13-hour trend is unequivocally up, you only buy on a dip, a natural temporary pullback within that upward momentum.
Wait for it to come back to you?
Exactly. You never chase a rising price. Similarly, if the 13-hour trend is down, you only sell on a rally when the price bounces up temporarily. It's about waiting for the market to offer you a better, lower risk entry point within the established trend direction. You use the trend's natural waves to your advantage and always trade in the direction of that main 13-hour trend. Never trade against it.
Okay, crystal clear. So what does this mean for those even smaller trends you might see flashing on shorter time frames?
Good question.
Sunel describes how movements like, say, 9-hour or even 3-hour trends are considered minor scalping opportunities, little quick trades.
Mm-hmm.
But here's the absolute critical point he makes, right? These smaller scalping opportunities must be nested within or perfectly aligned with that larger dominant 13-hour trend.
Absolutely crucial.
He says you should never trade against the 13-hour trend, not even for those short-term scalping opportunities. It's all about ensuring your smaller plays are always riding the bigger wave of the dominant market direction.
You got it. And to facilitate this crucial layered approach, SK actually provides specific Dantian channel settings for these different time frames. For instance, as we said, he suggests using 27 periods on a 30-minute chart for that key 13-hour turning point.
Right.
Then, you'd use smaller Dantian settings for your short-term scalps, but always making sure they consistently align with that dominant 13-hour trend direction indicated by the Chikou. This layered strategy is really key to ensuring your smaller, quicker trades are always supported by the broader market direction. It helps significantly minimize your risk and hopefully maximize your consistency.
It's like having the wind at your back, even for the small moves.
That's a great way to put it. So if we connect all of this to the bigger picture, what Sunel's approach really provides is this precise geometric framework for truly understanding and confidently trading trends in Forex. By moving beyond those traditional, often lagging indicators like simple moving averages.
Which cause so much confusion.
Right. And instead leveraging tools like the Chikou span and those invaluable Dantian channels, you gain a remarkably clearer, much less ambiguous view of market direction. And this clarity allows for far more precise entries and exits, and crucially, much better risk management, especially with that strategic use of the 13-hour trend as your primary guide. It's about seeing the market not as just a chaotic blur, but as a clear, unfolding geometric pattern.
So we've discussed these incredibly precise external tools for market analysis, the
Yes.
charts, the indicators. But Sunel argues that true mastery isn't just about reading charts. It's also profoundly about reading yourself.
Self-awareness.
Yeah. That's where he introduces your second friend in trading, right after the trend itself, your trading diary. And he means more than just a log of trades, doesn't he?
Much more.
It's a detailed, brutally honest record of every mistake you make, every single deviation from your own trading rules. It's a comprehensive, unfiltered record of your trading personality, as he calls it.
Knowing your weaknesses, your triggers.
Exactly. Knowing yourself, understanding your own tendencies and biases, SK says that's truly the indispensable first step to becoming a consistently good trader. You can't fix what you don't acknowledge.
Absolutely. And look, to truly master these techniques, to really see the power of these systems in action with all the charts and detailed examples that bring it all to life, Sunil Kuchel's book, A Practical System for Trading Forex, is really an invaluable resource. We highly recommend you get your copy if this approach resonates.
Definitely sounds like essential reading if you want that precision. Well, that brings us to the end of this deep dive. Until next time, keep learning, keep questioning, and keep deep diving into the knowledge that empowers you to navigate the markets with confidence.